you found the right lender? Well, you might want to think again. I mean, shopping for a home loan, shopping with a lender is not the same thing as shopping for a car.
There's a tool for every task, but it is determining which is appropriate, and most importantly, that's you making the decision, not the loan officer. Not just the wrong loan program, just, again, not knowing your job.
Let's talk about excessive fees.
Most loan officers don't know what causes market movement. They don't understand technical analysis. They don't understand when we're hitting resistant.
This is The Educated Homebuyer with Jeb Smith and Josh Lewis.
Think you found the right lender? Well, you might want to think again. Choosing the wrong one could end up costing you thousands, if not your dream home. From sloppy pre-approvals to hidden fees and bad loan advice, the wrong lender can lead you into a financial mess. Something that you'll probably regret for years. In this video, we're going to break down the costly mistakes that bad lenders are making so that you know exactly what to watch out for and how to protect your investment.
Absolutely, Mr. Jeb. Today is a fun conversation, and the genesis of the conversation is years. This may be hard to believe, Jeb, but the end of this year will be my 30th year of doing loans. So after 30 years, you hear a lot of crazy things. 3 years of doing this podcast, we get a greater volume of you guys reaching out and saying, well, I talked to this person, they said this. I talked to this person, I don't need to do that, or I shouldn't have to do that, or this is the truth. So a ton of misinformation out there. And the fact of the matter is probably about 20% of people reach out with some version of, I'm just trying to make sure I get the absolute lowest rate and fees. We've talked about, you guys are probably tired of hearing the broken record of saying that at least 80% of people in real estate and absolutely in mortgage are worthless. They're not good at their job. Your best case scenario is McDonald's drive-through, middle of the road. Okay, at midnight when you're on the road driving through Texas, you're happy to have it. But when you have your time and ability to do some research and get an expert on your side, you're going to be better off. So we're going to go through today all of the things that we regularly see that are costing people money. And the thing that is difficult about this, it's transparent, or it comes up at the very end. Everyone would like to reduce a transaction to a loan estimate where we could look at 12 loan estimates on paper and go, that's the best one. Mm-hmm. It is the best one, assuming that you're qualified for that loan, that it can be locked, that it was quoted correctly, that it's not going to change, that the ball's not going to get dropped, that we're not going to miss contingency times, that you're not going to get your loan not approved, that you're not going to get switched to a different program, or better yet, Jeb, that loan estimate is for the actual program that you should be placed on to begin with.
Yeah, I mean, shopping for a home loan, shopping with a lender is not the same thing as shopping for a car, right? There's a lot of TikToks, a lot of different things out there of how to get the best deal, the lowest rate at the car lot. This is not that process, guys. Guess what? They're going to get you into a car, and they're going to do things in order to get you in that process. Here, there's multiple people involved. There's a buyer, there's a seller, there's two agents, there's a lot of people. And guess what? There's other people, and many times lined up to get the same property that you're trying to get. And so if you don't work out, guess what? On to the next one. It's not that, hey, we're going to mess around with you and give you the time and deal with all of these different things, allowing you to change lenders at the last minute so that you get the house. No, you've got to abide by the contract. And what we're trying to do here is set you up in the process so that you're getting the important questions, the important things done early in the process so that you're not battling at the end, battling with your lender, battling with the real estate agent to get more time, battling with the seller to hold on and give me, another opportunity because your lender screwed up. So what we want to do here is start kind of at the beginning, and really kind of dial in the pre-approval process. Now, you guys hear this over and over and over again, but the reality is Josh probably has 4 to 5 people a week calling up where something went wrong because an I wasn't dotted, a T wasn't crossed at the beginning of the process. So Josh, kind of hammer down here what it means when you're working, with the wrong person and how things can go the wrong direction.
100%. From my perspective, from my team's perspective, me personally, I want to make it as easy as possible to get you a 100% accurate pre-approval up front. So if I'm asking you for something, it is because it is needed. I hear a version of, well, I talked to someone else, they didn't need to see that. Well, so-and-so told me I'm pre-approved, so I know I'm good. Okay, well, what did you give them? Well, we went through the phone conversation and they looked at a pay stub. Okay. Do they know that you're self-employed and you issue yourself that pay stub? Well, we didn't really talk about it. And it sounds crazy. You're like, well, that's dumb. Everyone knows that. Well, most borrowers don't know that, and many loan officers don't know all of the potential variations. So we've talked about on the show 1,000 times that first conversation before you complete an online loan application, before you provide any loan officer documentation, you should have a conversation up front to make sure you connect with them, to make sure they hear you, to make sure you think there's a good, viable reason to work with them. Because you don't need to get, even if you want to shop with 5 different lenders, you do not need to complete the pre-approval process with 5 different lenders. But you do need one that you know is going to get you honest, accurate, certain answers up front. And what that involves is having a conversation, usually no more than 10 minutes, where I ask you some questions about, okay, are either of you self-employed? Oh, okay, you are self-employed. Is that structure an S Corp, an LLC? Oh, it's a sole proprietorship. Just shows up on a Schedule C. So no pay stubs and no W-2s. You don't issue payroll to yourself. Oh, no, I don't do that. But that conversation allows me to get you a needs list that will allow me or any other lender to get a 100% accurate pre-approval. So accurate just means, hey, we're suggesting this loan program, or you asked for this loan program and you actually qualify for it. Like, it sounds so basic and fundamental that it's stupid that we're talking about it, but so many people don't ever start from that perspective. They're working with a loan officer that assumes things, that doesn't close loops, and is making promises based off of assumptions versus verified facts. And that is what the pre-approval is, and how a pre-approval varies from a pre-qualification.
Yeah, Josh, earlier you said you started the video 30 years in the business. Would you rather go to the doctor that just got out of grad school doing his first couple of surgeries, or the guy that's been doing it for 30 years? In most cases, the guy that's been doing it 30 years, as long as they're staying up to date with what's going on in the current environment, right? And as you can see from this podcast, that's us. We're trying to keep you up to date with what's happening right now and the mistakes that people are making by making the wrong choices. Now, Josh, it goes a little bit deeper than just the pre-approval process, because we're getting a lot of loan estimates because the refi boom, because of, we've kind of thrown it out there. Like, if you're going through this process and you're having questions and you want a second opinion or whatever, send us your loan estimate. Let us take a look at it. And one of the things we've seen a lot of is people going into the wrong program in some cases. Explain what you mean by that, because is there a loan program? We always say it's the loan program is the buyer's choice. It's not up for us or you to choose which direction they go. So how can a borrower be thrown into the loan, the wrong type of loan?
Well, we've told this story on the show before, but this is probably the best example. And going back, most loan programs, or many loan programs, are like specific use case. USDA, you have to meet income limits, be in a rural area. VA, you have to be a veteran. So for most of you listening at home, the question comes down to FHA versus conventional. And I hear crazy stories both ways of why, you only want to go FHA, or you never want to go FHA. And we have a client, unfortunately, for 3-4 months now, they have lost offer after offer. They have something very specific down in San Diego County that they want. But when we went through the numbers up front, he says, yeah, I'll look at the FHA, but I talked to another lender. They told me I don't want that. Why don't you want that? Well, I've got good credit. Okay, you have good credit. Why do you not want an FHA loan? Well, they have that upfront mortgage insurance premium. 100% true. So these are all true, but does that mean that you don't want it? He goes, I don't know. They told me I don't want it because I have to pay this upfront mortgage insurance premium. So, well, tell me what's most important to you. So first of all, let's table the conversation. Let's not even have it. I said, let me send you the numbers side by side, and you might look at it and go, I'm not paying that upfront mortgage insurance premium. That sucks. When we ran it, despite the fact that he has awesome credit, despite the fact that he could go conventional 3% down, conventional 5% down, he's going to have low mortgage insurance, the payment was about $200 lower on an FHA loan. 0 point loan, 0 point loan, a couple $100 difference in the monthly payment. He ran the numbers on an upfront mortgage insurance premium. He's like, within 18 months, I'm going to save that money. Because I think it was actually more like $300 difference on the payment. It was a $500,000 or $600,000 loan. But he ran the numbers himself, which is the way we suggest it. If you do something crazy and you come with a calculation that doesn't make sense, I will tell you, well, hey, maybe we should look at it this way. But he ran the numbers, and I'm like, totally valid. Whatever you look at and you feel that works in your brain is right. Both of these are good options for you, and no one should be telling you only do this one or only do that one. And the other loan officer that you talked to, she wouldn't even show him the FHA. And that could be because her company is shitty at FHA loans, could have terrible rates, could have terrible underwriting overlays where they can't do that. Any millions of differences. It could just be a personal bias. There's another person on YouTube that has a big and quality mortgage channel on YouTube, and she hates FHA loans. She's softened a little bit over the last few years, but basically they'd never do an FHA loan. That's crazy. There's a tool for every task, but it is determining which is appropriate. And most importantly, that's you making the decision, not the loan officer. The loan officer's job is to present the information so that you can make the best decision for you and your family.
Well, I'm actually going to go a little bit off our outline here, Josh, into another one real quick, because you said something that's important. You know, sometimes lenders have overlays. Sometimes lenders don't do loan programs. You could walk into your bank. You might bank at Chase, for example, and you might walk into Chase and ask them to do an FHA loan, and they might not do them, right? I mean, and even if they do, they might have an overlay on that program which says instead of a 580 credit score, we need a minimum of 640 or whatever it is, and therefore they say you don't qualify for that type of program or you don't meet the guidelines. And therefore, you leave with the idea that you are not in a position to buy a home, that you need to wait, you need to do something differently, when all it could be really is that lender didn't offer that loan program, or they didn't explain to you, hey, listen, if you go here, you can get it done. Side note, I had a refrigerator repair recently. My refrigerator, the line to the freezer, was broken, right? So no water was coming out of the dispenser. This is a built-in refrigerator. It's a $12,000, $14,000 refrigerator if you want to replace it. I don't want to replace a refrigerator. And so the guy leaves. This is from KitchenAid. Says, yeah, it can't be repaired. They no longer make that part anymore. And I thought, that seems weird. They can't repair that thing. So I call an appliance repair person, and he goes, yeah, it can be repaired. They don't have that piece. We just have to basically make two pieces for that hose to go back together, and the water will work again. Now, it might not hold forever, but it's a repairable piece. And I go, dude, I want to go that route. It was like $300 versus a new refrigerator. So take that into context. In like getting a loan, you could walk into some place and they say, yeah, that can't be done. Maybe it can't be done based off what they know, but that doesn't mean it can't be done based off the overall guidelines. And that's why it's important, Josh. I'm not saying a broker is the only option, but to go to somebody who has the options to send you into maybe another box. If you don't fit into box A, there's box B, C, D, so on and so forth.
100%. And Jeb, a secondary piece of this, we've talked about United Wholesale. It's the largest wholesale lender in the country, the largest lender overall. Even they don't have retail, but they do more loans in their wholesale than any other company does, retail and wholesale combined. But they do a sales meeting every Wednesday, and they give you points for looking at it that you can use to help your borrowers get better terms. So I was watching 2 weeks ago, and they were talking about Home Ready and Home Possible, which those are limited to borrowers that are at or below 80% of the area median income. But if you're eligible for those, you waive all loan level price adjustments and you get reduced mortgage insurance. If you're at or below 100% of the area median income, you're going to be able to waive LLPAs, which is going to get you much better pricing. And they were talking about 70% of the loans were coming in on the wrong program. The loan officer did not know. So they have idiot-proofed it. They have built a system. So if you're working with an idiot loan officer, hopefully they send their loan there, because they have idiot-proofed the system that they will go back and tell the loan officer, hey, dummy, you're on the wrong program. Your borrower can get better terms. Fannie Mae and Freddie Mac have built that messaging into their automated underwriting systems. We talk about DU, we talk about LPA. Both of them have messaging in there. Hey, it appears as though your borrower is eligible for LLPA waivers, and tells you to do that. But not just the wrong loan program, just again, not knowing your job. And this sounds shocking, and it sounds like, hey, Josh, you're being dramatic. I get questions from loan officers all the time that indicate that they have no clue what they're doing. Yet they're out there selling you confidently that they are your best option.
No, absolutely. I mean, there are a lot of real estate agents, a lot of mortgage professionals use this channel as an opportunity to take the information and convey it to their clients, which we appreciate, right? Because the information is accurate. This is what you should be doing as somebody out there learning and trying to hone in on your craft. But understand, like, if you're loan officer's not learning this and they're just kind of winging it on the side, you could be getting bad information. So with that, Josh, let's talk about rates and points. Two of the most popular things, and probably where you rather see the most mistakes. And let's talk about overpromise, underdeliver, and I guess we can start there.
100%. And let's talk about the difference between a refinance and a purchase. Generally, in a refinance, if you make phone calls for a day or two and you want to get the best terms, someone's going to quote you and know that you're going to be locking really quickly. So they need to give you pretty close to what they could lock that day. Now, on a purchase, think about this. We just talked about the client down in San Diego, 4 months. Whatever rates I quoted him up front, who cares if they were accurate or inaccurate, other than for him to make a decision of which program is the best, because rates are much better now than they were then. But many loan officers will take that and go, well, we don't know when they're going to get a house. I don't want them shopping and getting a lower quote. So let me fudge it by an eighth. Let me fudge it by a quarter and tell you that my rates are great. So now you're like, I made 10 calls. This guy's got the best rate. This girl's got the best rate in the history of the world. I'm not going to shop again when I get a property under contract. Now the contract comes in. You've already provided all your documentation, completed the loan application in terms of effort, time you've spent with that person, them doing pre-approvals for you. You feel committed, obligated, and then you get a rate that is very, very average. Unfortunately, there's not a lot you can do to protect against this, other than if you talk to 3 people and 2 of them are pretty similar and one of them is significantly out of line with that. We've talked about this. In the day and age of the internet, it's very easy to shop mortgage rates. So it's hard for someone to be out of line to the high side. They're out there. There are some direct lenders that do have really high rates and fees, and they use different fun little tactics to try and get you to pay premium terms for things that you don't need. Like, we can close in 10 days. Well, most sellers don't want to close in 10 days. But without going sideways of that, there's 2 ways. There's, hey, I'm going to quote you accurate rates, points, fees up front, or at least not accurate, but I'm going to underquote them, knowing that without a contract, we can't lock them. So if you're shopping, I'm going to sound great. There's the other piece of it. We had a client, Andy bought in Bakersfield about 4 or 5 months ago. Perfect online borrower if someone wants to do their loan online. 1 job, 20 years, all salary, low debt to income ratio, 800 credit score, all the money sitting in the bank. The dumbest loan officer in the world couldn't screw this up. So he goes to the biggest online lender in the world, does the application, uploads pay stubs, W-2. They send him the pre-approval. The terms look great. The terms make no reference to points. The 2 biggest online lenders in the country love doing this. If you're doing a purchase, they will give you a pre-approval. They will give you a rate that looks good. When you finally get a contract and send it over to them, they're going to give you a rate that is pretty much in line with where everyone in the market is, but you're going to have 1.25, 1.5, 1 3/4 points. And one of them will actually publish this rate on their website every day, but it says VA rates, assuming 700 credit score, it's VA, so zero down. This is what your rate is. And then down in little fine print, it'll say 1.37 points, 1.72 points. So when you just look at the rate, you're like, oh yeah, that rate's in line, and they're big and they're online and it's easy. I can do this in their cute little app. But you're getting the bait and switch in terms of no one mentions those points until it comes time to lock a rate. So for our borrower in Bakersfield, he was doing 3% down. He's like, why would I do 3% down and then pay you 1.5 points to get that interest rate?
Why so would I just put more money down?
I would just put more money down. I do 2%. Now I got 5% down. I got lower mortgage insurance. I get a little bit better interest rate. So it doesn't even make sense. Most of you guys watching the show are doing a minimum down, 3%, 3.5. If it's VA, 0 down. In any of those situations, if you're scraping up enough for your down payment and your closing costs, how does it make sense for you to pay another 1.5, 2% on there? There are times, and we've talked about this in the show, when it does make sense or we don't have a choice. So if we think in the next 3 to 5 years, this is the absolute best rates and they're going to go nowhere but higher, well, the points will repay themselves. You will have a recoup period and you'll be able to get through that before you were ever going to sell or refinance. But it is still a sunk cost. We also have people that, hey, I went and put a house under contract at 500 and I only qualify up to 475. The only way I can get that extra 25 grand is to pay a point and a half. Okay, I got to do it. It's the only way I can get into the house that I absolutely positively have to have. Or we have folks, hey, I'm buying this and next month I'm retiring. I'm not going to have qualifying income. So I want the lowest rate I can get because this is never getting refinanced. there are reasons why you may want to pay points. But we've talked about this before. We don't have a crystal ball going forward. We had a 40-year bull market in interest rates from 1982 to 2022. Month over month, they didn't go straight down, but year over year, rates went nowhere but down. My belief is the underlying fundamentals that led to that are still in place, and that will continue trending lower going forward. So we don't want to pay points. But again, this is a situation where it's your choice. Look at them side by side. Do I have the money? Do I want to pay the points to get the small benefit of a slightly lower monthly payment?
Yeah, I will say there's a misunderstanding out there in the market because people hear rates, right? They hear the average rate today is 6.5% or whatever, right? Or they're looking at some site and it says 6.5%. And that's typically conventional loans. That's what's being quoted out there in the market for the most part, right? What you're seeing out there usually is conventional. And so somebody doing an FHA or VA loan sees somebody offering them slightly better rate, maybe 6.25%, and they think, oh, this is a good deal. Understand, if you're getting an FHA or VA rate, it's typically 0.75%, sometimes 1% better than the market rate. So they're not doing you any favors by offering you a lower rate than what's being offered in conventional. You've got to understand where the market is. And even then, you shouldn't be paying points to get it. These are rates that are offered, typically par rates, where there shouldn't be any points paid, and they're considerably better. So if you're getting FHA, you're getting VA, just understand, talk to a couple of different lenders. Don't think that the one that you're talking to, because they quote unquote specialize in these things, that they're the only person you should talk to. No, talk to multiple people, and that way you know exactly what you're getting. I mean, in fact, we had somebody this morning send over a loan estimate, Josh. I forget what state they're in, but they were getting an FHA loan. Maryland, getting an FHA loan. They sent it over to me. I forwarded it to you and said, hey, Josh, can you read in on this? And it ended up being a good deal. They were getting offered 5.75%. They weren't paying any points. In fact, the lender was giving them a credit to cover the little fees that they had. And they were coming down from, I think, a 7.1 on a $250,000 or so loan. So they were actually saving pretty good amount of money per month. That's a good deal, right? Nothing we can do to make that any better, but that's what you need, is somebody to look at that and go, hey, listen, this is a good deal. You should move forward with it. So if you're out there shopping, you want a second opinion, want Josh to help, reach out using that link in the description of this video, and we'll be happy to, the team here will be happy to guide you through the process and make sure you're getting good terms.
And the reason, Jeb, why we're happy to do that is it makes me happy to be able to tell someone, brother, you're in good hands. Just keep going down that path. Those are really good numbers. But that's the exception rather than the rule. I don't know if it's 2 out of 3, 3 out of 4. Most of them come over and you look at it and you're like, what insanity is this? Like, some of them are just truly bonkers quotes. And you're looking at it going, what are we talking about? We got one last week that both of them.
You sent it to me. I wish I could find it while we're online.
2 different FHA streamlined quotes. Both were 1.25 above market and paying 1.5 to 2 points to get a rate that was above market. The loan officer was going to make, we backed into the numbers, somewhere between $17,000, $18,000 on a $500,000 loan. That's bonkers. Like, if you make that on a $2.5 million loan, good for you. If you make that on a $500,000 loan, you are a
make
thief.
it 3 points. That's crazy. Yeah. Over 3 points.
Yeah.
We'll do an episode on that video. But with that, Josh, let's talk about excessive fees, because excessive fees are pretty common out there in the industry, because, again, borrowers don't know what they don't know. They don't know that they're not supposed to pay this. They don't know that they can get that rate without paying points. So what are we seeing on the excessive fee front?
So the biggest one, and it's often like green loan officers new in the business, or they work at a big direct lender and they've just been told this is how we do our refinances. Box A, we've talked about, and I don't care what's in box A. Discount points will go there. Origination fee will go there. Underwriting fee, processing fee. Add them all up, and that's the cost of the rate. So some places are higher, some are lower. Sometimes you'll see them as high as $2,200, $2,300, $2,500 of box A fees other than points. Sometimes you'll see them as low as zero. But again, sometimes that zero has a little higher interest rate. Sometimes the place with higher fees will have a little better interest rate. These aren't rules. You can't count on that. But what I'm saying is you have to look at both in context. But that is, the lender's going to know that. It is what it is. So expect somewhere between $1,000 and $2,000 in box A lender fees. If you get zero there, you're probably paying a small premium in interest rate to buy that out, which is valid and possible. So any of those are good and fine. Box B is going to be really, really consistent from lender to lender. Those are the items that you cannot shop for. We have to get a credit report. We don't say, hey, Jeb, where would you like me to pull your credit report? We use a credit vendor on every one of those. That is the fee. And they're all going to be very consistent, somewhere between $50 and $100. An appraisal. We don't get to pick the appraisal anymore. We pick the appraisal management company, and those vary. They vary where you're at, but from lender to lender, they shouldn't vary a whole heck of a lot. So especially on refis, because this is where we get to pick them, in Box C, now you have things that technically you can shop for. So title fees, escrow fees, attorney's fees, settlement fees, those are the things that are going to show up in Box C. On a purchase, you still technically have the ability to shop for them, but you've already agreed to who you're going to use in your contract. You and the seller have negotiated, this is our escrow company, this is the attorney we're using, this is the settlement service provider. So on a purchase, it's not that big of a deal because I get the contract, and whether you come to me or lender B or lender C, we're all bound by the terms of that contract. Box C is going to be the same. Same thing with all of the prepaids on the right side. If they're quoted accurately, they're all going to be the same from lender to lender. But in Box C, I've seen numbers as much as, we had a client the other day that California, in many other states, we have a really low cost vendor for title. We were at like $1,100. They sent over a comparison that everything else was right in line, and that was $3,000. I'm like, what are we talking about? It wouldn't be $3,000 on a purchase. On refinances, where the title and escrow company, title is insuring the 12 to 18 months since you bought the home. That's not a whole lot of insurance, because whoever did the title insurance when you purchased, they're on the hook for everything that came before that. So whoever's insuring is just covering that little brief interim period. There's no insurance risk. Lots of companies will do that very cheap. On the settlement services, what are they doing on a purchase? They're ordering a payoff demand. They're putting out a basic set of escrow instructions. Very, very basic. So we have providers that will do a B+ job at a rock bottom price. And most lenders do. I rarely see anyone cheaper than us. We see some in the ballpark with us, some a little bit higher. And every now and again, you're looking going, what am I looking at? How does this person know? It doesn't pad their pocket. It's not any better for them. It's just ignorance that they don't know that you could save the borrower $1,000, $2,000 in Box C fees.
All right, so let's move that into closing costs. We're kind of talking about closing costs here a little bit with fees, overquoting, underquoting. There is a loan estimate, so you're kind of restricted in what you can do with regard to fees. But how are those getting screwed up?
The fees, there's not a whole lot there, because again, what does the lender control? Box A and Box B. They're going to quote Box B correctly because there's not a whole heck of a lot there. But Box A stuff, as soon as that loan is locked, you have to get a locked loan estimate within 3 days, and the Box A stuff cannot change. So same thing, purchase contract comes in. I have to make a disclosure to you within 3 days. The rate and points can change if you haven't locked it, but the fees that we're quoting in Box A cannot change. So really, are we going to a high fee, high cost lender? And at risk of calling anyone out, there are a handful of major national direct mortgage banks that generally work with boots on the ground loan officers, not big call centers. So some of the best, highest producing loan officers in the country work for these companies, and they are known for having high fees and high rates. So your Box A is at that high end, $1,800 to $2,500 of Box A fees. Your interest rate is going to be 1/8 to 1/4 above the market, or 1/2 to 3/4% on a government loan, because they're really poorly priced on government loans. And that was what I was talking about earlier. These are the types of lenders that are going to try and dazzle you with bullshit. Here's your guaranteed pre-approval letter. We'll pay the seller $10,000 if we don't close on time, and we can close within 10 days, which again, you as a realtor can comment on that. Most sellers are not prepared, willing, or ready to move out of their house in 10 days. So whether it's 17, 24, 30 days, there's not really a need to close in 10 days, and it's really meant to dazzle you. These same lenders, instead of sending you out a loan estimate, or even, we've talked about, you don't have to get a loan estimate, a fee worksheet that gives you an itemization, not just a summary of the cost. When I send out figures to a borrower, the first page is the summary. Here's closing costs, here's prepaids, here's down payment, here's total cash to close. So you can see your rate, your payment, and how much money I need. But page 2 gives you a breakdown where you can see where all that's going. I see these lenders, I know who they are. Like when someone sends over, hey, this is what it'll be, like a little screenshot like this big that says, this is your rate and your payment. Like they don't want to show you anything else. And they're going to tell you lines like, oh, it's going to be the same wherever you go. It's all written into the contract. Well, it is, except for box A, and it is, except for that interest rate. And when that interest rate isn't locked, magically, one of these lenders, without naming them by name, their loan officers are taught, they don't give you an interest rate. Oh, today's rates are between 7.25% and 7.5%. That's a pretty big difference. And the range always includes what a normal rate, what a market rate should look like. But what they're actually going to lock you at is at the high end of that range. So again, if you're not locking today, you can't really hold anyone's feet to the fire. But if they can't give you a quote of what that number is today, just run. It is a sales tactic to hide that I have high interest rates.
All right. So, Josh, let's talk about rate locks. Rate locks and closing on time. Two kind of go hand in hand to some degree. A rate lock can be anywhere from 15 days, 30 days, 45 days. I mean, obviously increments in between or whatever, but most common is probably a 30-day lock. And what happens to a borrower when that rate lock expires? Because the borrower doesn't know. They have no idea that there's a fee involved in order to extend that lock. So whose responsibility is that? Whose cost is that? And could they end up delaying the close and end up losing the property because of it?
Many times it is very difficult for, especially if you're dealing with a broker. We talk about the good sides of brokering loans, and it is positive. But the banking lobby was able to get a disparate set of guidelines. So banks don't have to disclose what they're making on the loan. They can offer a lender credit at closing. They can make less on one, more on another. Whereas on a brokered loan, it has to be set in stone upfront, cannot change. So a lot of times you will end up on the hook for a rate lock extension because it's very, very hard to prove who was the cause of the delay. But more so than lender broker caused delays pushing a closing late and having to get a lock extension, the bigger one that I would look at is just malpractice of having no idea what they're doing, always being hopeful that rates are going to get better in the future, and telling people, oh, we're going to be okay. That rate that I quoted you last Wednesday no longer exists, but I think tomorrow we get the weekly unemployment claims. It's probably going to come in good and get better. We have a friend, 3 doors down here, Jeb, and he has a little guy that used to be his loan officer assistant, and now he's doing loans on his own. I'm walking out to the restroom one day, we start having a conversation. He's like, just stressed, hair going sideways. Like, what's going on, buddy? I just got 2 loans. We got these purchase contracts, told the borrowers we got them locked and they're not locked, and rates are a bunch worse. I don't know what we're going to do. And it sounds like that would not be common. But if you go into any loan officer forums, whether it's a giant Facebook group or some of these different groups online, regularly loan officers have got themselves in a pickle by implying that they have some sort of insights into what's going to happen going forward with interest rates when they don't. We talk about interest rates a lot here, generally prefaced with, we don't have a crystal ball. Here's the odds going forward of what is likely to happen. And if we're going to close in 15, 21, 30 days, probably best to just take that risk off of the table unless we have a really, really, really strong feeling that rates are only going to go down during this time. So what I see most commonly is just spectacularly bad advice from loan officers. Talk to one of the inside assistants at our company that helps 8 or 10 different loan officers. And I will go and say that the other loan officers that work under our company are, I'm not going to say they're the cream of the crop, but they're way above average. And he said he lost about 50% of the refis that he was working on 2 weeks ago when rates shot up 1/4 to 0.5% in 3 to 5 days, because many borrowers, and again, a refinance is very different than a purchase, but many borrowers felt like, well, I don't want to lock, rates are going down. And most loan officers don't know what causes market movement. They don't understand technical analysis. They don't understand when we're hitting resistance, when we're likely to give something back, and they aren't able to. My job, I say push back. I don't push back on a borrower, but I want to give them all of the information that I have, because we don't have a crystal ball. There is no right answer. But if you were coming down from a 7.5 to a 5.875 and you're telling me you want to wait for it to go lower, I'm probably going to push back on you. If you're at 6 3/8 and you say, hey, I want to wait and see if it goes to 5.5, maybe a more valid and defensible decision. But just I'm not even sure what questions you would ask a loan officer, but I can tell you 95% of them do not have a handle on what's going on with the market, and they don't have the level of experience needed to help you come to an understanding of your risk tolerance level and whether you are comfortable floating that rate. So again, if you shop around, you find the cheapest lender on the planet, but he's not pushing you, he or she is not pushing you to lock that rate, and you're not on top of that. 3, 4, 5 days later, he could be significantly more expensive than an average priced loan officer or lender. So from that perspective, it really, that rate management is a very important piece. Not that, someone has some type of crystal ball or special insights that's going to allow you to ride the market and lock at the absolute bottom. They're going to avoid putting you at risk of losing an eighth or a quarter because the market went against you.
Yeah, and with that, guys, let us know in the comments below what's the most important to you when working with a lender. What have you heard here? What do you think is the most important? Drop us a line in the comments below, and maybe we can make a video off that alone. But until next time, guys, make sure you buy right, borrow smart, build wealth. Adios.
Amigos.